Everyone, welcome back to my channel. I am Desilia Utami, NPM 2441201 from accounting class 24A. Today, we are going to explore a very important topic in financial management, the difference between bank and non-bank financial institutions. Even though both play a key role in our economy, their function, service, and objective are quite different. Understanding this difference will help you see how money flow within the economy and how financial system support growth and stability. Let's begin with banks. A bank is a financial institution that collects money from the public in the form of deposit and distribute it again as loans or credit. In Indonesia, banks operate under Law Number 10 of 109,098, which regulates all activities in the banking sector. This law ensures that banks operate fairly, safely, and in line with national economic goals. Banks provide a wide range of services such as saving accounts, time deposit, credit cards, and loans, as well as money transfer, foreign exchange transaction, and investment advice. They are considered the heart of the financial system because they make it easier for money to move between people, business, and the government. For example, when you deposit your salary in a bank, that money can later be used by the bank to provide loans to entrepreneurs who want to start or expand their business. This process helps drive production, employment, and income growth, showing how banks stimulate the economy. In Indonesia, we have several types of banks. Commercial banks offer general financial service to the public, while rural banks or bank perkreditan rakyat focus on serving local communities and micro enterprise. Each bank has a special role. Commercial banks handle large operations, while rural banks support smaller community-based financing. Now, what about non-bank financial institutions? These are organizations that provide financial service but do not accept deposit like banks do. Example include insurance companies, pension funds, leasing companies, finance firms, and investment institutions such as mutual funds and securities companies. Their main function is to support financial intermediation, helping people and business manage risk, save for the future, and obtain financing through non-traditional methods. For instance, an insurance company helps individuals protect themselves from financial loss, while a pension fund ensures that employees have income security after retirement. A finance company might provide leasing for cars or equipment, making it easier for business to grow without heavy upfront costs. So, what's the key difference between banks and non-bank financial institutions? The main distinction lies in their core activities. Banks collect funds from the public through deposit and are part of the payment system, while non-bank financial institutions don't collect deposit but offer special financial services such as insurance, leasing, and investment management. In other words, banks focus on liquidity and payments, while non-banks focus on investment, risk management, and long-term financing. Even though their roles are different, both types of institutions complement each other. When banks provide loans and payment facilities, non-bank institutions offer insurance, investment, and financing alternative, forming a balanced, resilient financial ecosystem. Together, banks and non-bank institutions make a major contribution to national economic development. They help mobilize public funds, create job opportunities, and ensure that financial resources flow efficiently across all economic sectors. In recent years, Indonesia has also experienced a rapid growth in financial technology or fintech, which has blurred the lines between bank and non-bank institutions. For example, digital lending platform and e-wallet service are often run by non-bank companies, but they work closely with traditional banks to expand access to financial service. This collaboration increases financial inclusion, especially for small business and individuals who were previously unable to access banking service. However, both banks and non-bank financial institutions face various challenges. They must keep up with digital transformation, cybersecurity threats, and change in consumer behavior. Regulators such as OJK ensure that both sectors remain transparent, accountable, and stable, protecting the public trust in the financial system. Looking ahead, the integration of technology, innovation, and good governance will play an important role in shaping the future of financial institutions in Indonesia. The collaboration between banks, non-banks, and fintech companies will continue to drive economic growth and help the nation achieve financial sustainability. To wrap it up, both bank and non-bank financial institutions are crucial pillars of Indonesia's financial system. Each plays a unique role, but when they work together, they create a strong, inclusive, and dynamic economy. By understanding their function and difference, we can better appreciate how financial institutions impact our daily life and the nation's economic progress. Thank you so much for watching. Don't forget to like, comment, and subscribe for more videos about financial management and education. See you in the next video. See you next time, and bye bye.